Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending August 31, 2018. So as we round up the second month in Q3, we had a very strong month. In fact, we've had 5 months in a row where both the S&P and the NASDAQ have closed higher. This week, the NASDAQ was up a whopping over 2%. S&P was up just slightly under 1%, and the Dow was up just slightly under or just slightly over a 0.5%. So they've been moving very strong. And the other thing that is just amazing here is that given some of these trade tariff issues with China, the market seemed to be brushing that off. I know with Mexico, we seem to have brought that to hopefully a closure this past week. And then maybe we'll see if Canada jumps on board. But we've also got the strongest consumer confidence that we've had going all the way back to 2000. That's almost 18 years. So we've got strong consumer confidence. We've got inflation that's so far held in check. Consumer spending is very strong. And then let's keep in mind that the earnings that came out in Q2, over 25% year over year growth. We've had strong Q1 earnings. In fact, if you look at the chart here I have of the E-mini S&P 500 futures, we made all-time highs this past week. We're near them. And you can see here that we've taken out the highs, former all-time highs that were made back in late January. Now, I will point out, right now we're at about a 16.8 12-month forward earnings PE ratio. Back here in January, we were at a 12-month forward earnings at 18.6. So you may be saying, why is the PE ratio lower, even though we're at a higher price than we were in January? And the primary reason, and the only reason to be honest, is earnings. Earnings are very strong, and that can drive markets higher. So we're not in the same situation that we were in January with a higher PE and a lot of air underneath us. Now, this does not suggest that we can't have any pullbacks. I do believe September, which is going back to 1950, September has traditionally not been a very good month for the markets. It typically falls over about a 0.5% for the S&P and about 70 basis points for the Dow. Volatility also seems to finish higher at the end of September than the beginning. So September hasn't, going back almost 70 years, been that strong for the markets. But this is kind of what we're sitting at right now. We've got this strong move higher across all of the markets, highs everywhere, but in the U.S. markets. Now, as we go through this long holiday weekend for the U.S. market, Monday will be a holiday, Labor Day. All other markets around the planet will be open. Most of them will be. But there'll be very low trading volume until the U.S. comes back on board on Tuesday. And you can see here this runaway freight train that we've had with the U.S. markets. You can see as I step it out, this green line, which is the trend line. And we've just been, everything has been a buy the dip. And even though we had this pullback of over 10% of an official correction back in late January, early February, we've still very, very strong. And we're taking everything out and we're moving higher. If I look at NASDAQ, it's the same thing. But look at the trend line on NASDAQ. You can see this line here is even steeper. This angle of ascent is very steep. That's why I think we're starting to get a little bit over exuberant and move higher here. This could pull back a little bit, but again, nothing that I see is very serious. And if we look at the Russell, it's going to be the same thing. The Russell's got a fairly high angle of ascent of the trend line. And you can see here we made all-time highs on Friday with the Russell and a 2018 high as well, of course. But I do see some softening in price action going into September. If anything, it's just a little bit of profit taking. Okay, nothing very, very serious coming up here. I don't see that anywhere on the horizon. We're still in this buy the dip kind of thing. Now, if we look at the Dow, that is the only one that is, we've moved back into the green for the year. You can see we took out a prior pivot high here. There's clear sailing up to the all-time highs for the Dow, but the only thing that's putting downward pressure on the Dow is potential tariffs that Trump may slap on 200 billion. The quiet period officially ends on Wednesday, and then the tariffs could hit anytime thereafter. So we've got these issues here with the tariffs that's providing a little bit of downward pressure on the Dow. But notice, even with all these tariffs, the markets are still moving strong. Okay. Um, and we've got a Fed rate hike possibly coming up here on September 26th. It's like, I think, a 94.6% probability of Fed rate hike, taking our interest rates here in the US up to 2 to 2.25%. And then in December, there's a 63.6% chance of another Fed rate hike. That would give us 4 for the year. And yet the markets continue to climb higher. That shows you what strong earnings will do. But I think earnings are going to start to top out next year and run sideways to slightly down. I think you'll see a little bit more of a pullback in the markets, but nothing serious yet. I don't see that there. There's plenty of things out there that could set the markets ablaze. We've got huge debt issues in China. We got Italy with a lot of you may not realize, Italy is the third largest bond market in the world. That's how they've been financing a lot of their debt. And their interest rates are still artificially low because Super Mario Draghi there, running the ECB, has been buying a lot of that debt. So it's going to put him in a quandary here as we go into Q4, because he has said he's going to stop buying debt in Q4. So what happens to Italian bonds? If they start going up, the contagion is going to immediately go over to Spain, which is also not that strong from an economic standpoint, and then Portugal. 3 of the socialist or the more socialistic countries across Europe. And then, of course, we got Turkey, which is not in the ECB, but they're in the EU, European Union, and they've got issues with their lira. So that could also pose a threat outside of Turkish borders, probably to Italy, Portugal, and Spain, who are also holding some of that debt on their own books, some of the banks in those countries. So we've got that there. And then we've also got the issues in Venezuela with their peso being just completely going underwater. So we do have a number of things out there, dry kindling, that could set the market ablaze. But I just don't see anything before going into the end of the year that can move us down like we had in January timeframe. I think 2 to 3 or 4% would make sense to me, and set the stage for a strong rally in the end of the year. But I don't see anything else much out of that. Okay. Or certainly at a minimum, some sideways movement here for a bit. If we look at the Dow Jones Transports, you can see here also, as the Dow Jones Transports come up, we made highs for 2018 just a few weeks ago, or a week or so ago. Okay. So when you've got strength in the Dow Jones Transports, it tends to lead the Dow. And as I showed you before, the Dow took out this key pivot point right here, and we got some free range running to run up a little bit higher. If we look at the Vanguard All World Index, however, things are not so rosy around the planet. You can see right here, I could just draw this trend line, and you can just see, I'll just put this trend line in here, or this channel rather, probably better said. I just put this channel in like this. We're testing the top of it, or it goes like this, really. So you can see here, this is where we closed on Friday. So we're kind of inside this channel right here. And there's the center of that channel right there. It's clear the direction that's going in, guys. This is the Vanguard All World Index. So it kind of just shows where the rest of the planet is going. And that is in that direction, right? With that angle of a descent. That's not good. We were down low at 14.7% off the highs made in January, but we have not recovered like the U.S. markets. In fact, if we take a look at, let's take a look at the emerging markets, which are, not the all world index, but it shows some of the smaller countries, some of the more volatile countries. And if we look at the emerging markets, look at this right here. This one here is also similarly positioned. If I were to draw this channel like this, you can see that we've actually, and it's not a very straight line, but you get the idea. We're sitting right here at the bottom of this channel. If I were to draw this kind of more straight, we're down like this. But again, the angle of descent is the same as the Vanguard All World Index. And we actually moved into a bear market on emerging markets, and then we've since climbed out, but just barely. So the rest of the planet is not doing good. Now, if we were to look at China China's the worst because they're feeling the brunt of these tariffs, and Trump believes that that's going to force them back to the table. So if we look at China, you can see here with China. I mean, we're down. We were down 32.14% from the highs made in January. That's clearly bear market territory. We're still in a bear market with China. They're feeling the impact of the tariffs much more so than everybody else. So the big issue is we've got this kindling that's set up in Italy, Venezuela, Turkey, China. And then we've got the Iran oil embargo that's going to hit again November 4th. So we've got some things out there that could light the wood and set everything ablaze. I don't think it's going to happen. And short of that, though, I think we're going to continue to make new highs as we move through the end of this year, but not without 1 or 2 or 3% pullback or some sideways chop. Volatility is very low. We finished the week at 1286. I think we're subject to some up moves involved. We're still in zone 1. All right. As you can see on the right hand side of the screen, which is the green zone. We're playing volatility basically to the long side right now, although I'm waiting for some trades in VXX, which would be a short trade, which tend to be high probability trades for us and for our members. If we come down here and we look at treasuries, the bond market was flat on Friday. It's down just a little bit. Every time the bond market gets up in this area up here, I like selling it, not buying it. Okay. And now we're seeing bonds down in this area here. I think we could get it back up in this area. I'd be more willing to sell it than buy it. Okay. We look at the 10-year interest rate, all for the highs made the middle of May. And we're sitting down here. These 10-year interest rates are sitting at 2.85. And you may be saying, well, heck, with, excuse me, with the Feds hiking the rates possibly 4 times this year, why are the rates falling? And that's because money is coming in from other countries, big time. The German 10-year is sitting under 0.5%. So why invest in Germany when you can come over and buy the U.S.? You could buy a 90-day U.S. for over 2%. So why buy German? And all that money coming over here from Japan and Europe tends to suppress our interest rates, tends to increase the dollar. And speaking of the dollar, excuse me, I got a bout of the coughs here. If we look at the dollar here, you can see here this move higher right here, right? I don't think the dollar is going to make new 2018 highs. It's possible, but I don't see it. I see a little bit of a run higher, but I think the dollar is going to find more support between the 50 and the 200 than running up. All right, that's the dollar. However, the one thing that can make the dollar go up, which wouldn't be the dollar index. Remember, it's the dollar index, not the dollar. So the one thing that can make the dollar index move higher is the euro moving lower. And I just see there's a lot of things on the horizon that could really just catapult the euro back down below the 2018 lows here. There are a lot of things, as I mentioned, Italy, Turkey, contagion over into Europe, Spain and Portugal. They've got some issues over there, guys. And then let alone the Brexit, even though they're not part of the ECB, a bad Brexit will just crater the British pound. And then the contagion effect with Europe, because they do a lot of trading with Europe, can be equally bad, which will move the euro lower and the dollar higher, or the dollar index higher. If we look at the British pound, now I want this to just keep getting lower and lower and lower. Okay, if we look at it on a daily chart, take it out a little bit, you can just see here where we are right now on the British pound. I want it to come down in this area down here. Remember, for our members and for those of you that have been following my weekly roundup, you know, we've been trading the pound in this channel going higher. It's been a great trade for us. And actually, when the pound got outside the channel up here, we were not going long, and we won't chase it. Then when it came back into the channel, I was expecting this thing to hit the bottom of the channel and move back up. I was ready for some long positions. We never got the long trigger. It just fell out of the channel, tested this prior pivot low, and then away we went. So I've now switched my thesis on the pound. And a lot of this has to do with the Brexit. And if it's an ugly breakup, then the pound is going to come back down and challenge these lows down here. And at that point, if it gets down there, folks, we're going to be happy because we're going to be taking this contrarian play to the upside. I think it'll be a good play for us. If we look at gold, gold, as I've been saying here in these weekly roundups for months now, gold is a downside play. Any rise in gold, you should sell it. And you can see here on this daily chart how we just kind of hung out right here for over a month at the 1300 level. And then poof, away we went. Now we're trying to get some escape velocity off of these 2018 lows. Remember, from the 2018 high to 2018 low, it's 14.77%. So we're in a correction territory. I think the correction's not over with. Okay. Same thing with silver. I think the correction is not over with, but eventually we're going to catch wind and move up. But look at all this resistance up here. We got 2016, 17, and 2018 highs, all very close to each other, right? That means there is a ton of resistance. If we were to back it out on a weekly chart, I can show you here just all this resistance setting up here. All right. You can see this whole area right here. I believe gold can come down and test the 2018, possibly come down to 1124. But then once we get out of this area here, we're going to start moving back up. And then once we break this, we're going to be running for the races to 1400 to 1500, but not now. As I've been saying, over the next year, year and a half, we're going to have the bear of all bear markets, and it's going to be ugly. And that's when we're going to see gold switch around. Right now, I do not see it. Copper is another one that's just getting killed, primarily because of China. Everything that's tied to China is getting killed. Look, this is a weekly chart of copper. Let's come into the daily so you can see the severity of this pullback. Look at this. It happened, and it was only June, not that long ago, and then copper just gave it all up with these trade tariffs. Now, it's going to do the same thing to the upside when these tariffs get solved. But right now, copper is just being killed. And for our members, I talked about different ways to play copper if you don't want to get into the futures market. Really, probably an easier way is the ETF tracking for copper miners, COPX, right? That would be the easy way to play copper to the upside. Right now, we're not ready for it. I still think there's more downside in it, but when it's ready to start moving, I think it's going to be good. Oil is another one that did kind of what I said it would do. It came back. I was forecasting oil to get to around the 63.50, 63 area. It came down just short of there, about $1 a barrel. And now we're moving back up, but we haven't been able to take out that trend line there. This trend line, by the way, goes way back here to this area here, right around 2017. And you can see, I believe we're going to run up here, hit it, and bounce and come back lower again. Meanwhile, Brent is on a tear to the upside. Brent is going to be more bullish than WTI. Look at Brent; it's already back over its trend line and regain back up. I think Brent's going to challenge these highs here. Why? Because the oil tariffs or the oil embargo is due to hit November 4th, and they're forecasting 1 million to 1.5 million barrels of oil coming off the markets when that happens. So it's going to move Brent and affect Brent much more than it's going to affect West Texas Intermediate oil here in the U.S. If we look at the spread between the two, this is Brent minus WTI. You can see right here that this is really moving higher here, this spread. So that means the difference between Brent and oil here in the U.S., WTI is widening. So playing the spread to the upside makes sense. Over here, we played the spread to the downside. Now it makes sense because with this fuel embargo or oil embargo with Iran, this thing can come back up and challenge these highs back up here. So let's watch this very closely. Meanwhile, in agriculture, corn, soybeans, I like these to the upside. We've got some trades here for our members that are setting up that'll be really interesting. Another one that's really interesting to me is in the lean hogs, lean hog futures. You can see this looks ugly to the downside. I do believe we could see some upside here shortly. A lot of this is affected by the Chinese trade tariffs. If that goes away, lean hogs is going to come back up really fast. But there's another thing out there with lean hogs, and that's a bovine flu over in China. And if that spreads, we're going to see that move up. in spite of the Chinese tariffs. But if the Chinese tariffs go away, that's going to be a good long position for lean hogs. All right, everybody. I know it's a holiday weekend for everybody on this watching this video from the U.S. market. So Monday will be closed. Other country indexes will be open, but the trading volume will be low. If you're not a member of our group, I highly encourage you to come in. We're having a great time. The end of this year is going to offer up some surprises in the currency market, the bond market, and clearly in the commodity market that we're starting to see set up here. So I'd invite you to come in, take a gander at the offer we're putting out on this. Otherwise, everybody have a great weekend. U.S. folks have a great holiday weekend. Members, Sunday night we will not have our weekly market watch. It will be this coming Wednesday morning in our pre-market session. All right, everybody, have a great weekend. Ciao, folks.